Rahat, long time. Glad to have you on, man. How you been?
Yeah, good man. Good. Thanks for having me back. Good to be back. It's been
My
a pretty
pleasure.
big week.
It's
Big,
been a
big,
massive
big
week.
last week.
It's been a
Yeah,
massive
no,
week. I'm surprised you found time. I know you've been bombarded with calls in the last, few days. So thank you for
it's
coming
been
on.
nonstop.
Yes, yes. And I've even taken some of your time. So, again, really appreciate you coming on, man. Today's a big one. We're going to just unpack everything that happened this week with the budget. Obviously, some big changes, a lot of implications on, all Australians. And we're just going to deep down into, is it actually helping? What are the, main repercussions? And who's going to be, be at the most benefit? I think that's the main thing. I'll just quickly, just get this started with the budget overview. So just very top level, man. Like I'm pretty disappointed with the budget. I truly believe, it's I hate to say it, but it's like a government cash grab. I just think that they're taxing more and they've disrupted the kind of environment from property investment to taxes to different structures. It's not really helping anyone. I would really have loved to see a lot more emphasis on how we can, increase revenue as a country without having to tax the everyday Australian. I think, a lot of that will be focused on natural minerals, gas, maximizing our revenue there. We should be one of the richest and most wealthiest countries in the world. And still now the government just refuses to, answer questions or, talk too much about this. Instead, they're taxing us more. And ultimately, I just don't think any of the policies really helped, cost of living crisis, the housing crisis. There's no real incentive to, showcase how we're building more properties or helping affordability. A lot of these, which we'll deep down today, but a lot of the incentives and a lot of the changes in the budget, I think, are doing the exact opposite. So that's really what I want to discuss with you. And I'm glad we have some time to digest. I know you've been, just really busy with our clients, even for us, we're calling you as well, just understand, what to do next. Because while it's not a significant change for your everyday investor, if you have, certain structures and put in place or you're looking to get into the market after the budget, obviously you're not going to miss out on, buying the right property and getting the growth, but it's all about how you optimize and make sure you've set up yourself for success for the long run and for the family to build wealth. So yeah, like overall, man, like, I think I wasn't too happy about it. I know you have some thoughts as well. So share your overall opinions first.
I've got very similar opinions to yours. I've been pretty disappointed with the budget. They promised something 12 months ago. They promised they're not going to touch the negative gearing or the capital gains discount, and they've just gone completely 360 on that. They black flipped on that, and they've removed the negative gearing and capital gains discount altogether. Although, albeit all the investors that have bought the property pre 12th of May 2026 will be exempt from the changes, especially the negative gearing changes. The CGT changes will still apply till 30th of June 2027, and post that we're going to go to what is called the indexed cost-based method.
Mhm.
They promise that they're not going to touch that, which is a huge loss of trust, within the government. I don't think we can ever consider the word that they say. They say something and then they completely backflip on that. That is completely not right. When it comes to tax changes, look, personally, what I think is it's not all doom and gloom. Even though these changes, the headlines, the outside noise, people will start to panic in a lot of the locations, but I think you still have to stick to the fundamentals, which is demand and supply. They're doing nothing to impact the supply, which basically means that with more migration numbers coming in, we're going to see rental prices keep going up. We're going to see the supply not coping up with the demand, and ultimately, what's going to happen is the house prices will keep going up
Agree,
in
man.
in the
And
right locations. In the right locations,
yeah,
that's
that's
the key word.
very true. Yeah, exactly.
Yeah,
Yeah.
we'll still see fall in a lot of the properties where a lot of the investors were pumping money because of negative gearing, and a lot of these locations didn't make sense. Like for example, Sydney. Median house price is 1.7 million. In the next 10 years, it was predicted to cross over 3 million. This wasn't good for anyone. So these sort of markets, sort of had to flatline. But personally, what I think is this is purely not because of the budget. This is also because of what's going on with the interest rates. The interest rates been really high over the last, 2 to 3 years. It's almost 4.35%. Correct me if I'm wrong. But 4.35% we haven't seen in the last 10 to 15 years. And
Yeah.
that's causing a lot of people to, either dispose the property off or not being able to afford the property. And when they talk about intergenerational fairness, I don't see how that's happening either. Personally, like they've grandfathered the change to all the baby boomers who have made all these use of the negative gearing and the trust distribution, trust splitting, and now all of a sudden the new generation will not be able to negatively gear the established homes, albeit they'll be able to negatively gear the new homes. But some people would say even the new homes in the wrong location is not a very good investment. So, personally, I just don't see that's a good way to go
Yeah,
forward.
man. 100%. Let's start with into general fairness. I think that's one of the main kind of topics that were meant to be covered and addressed in the
Yeah,
budget. So, like, what I found was there was mainly three things that will actually make this worse for like a first-home buyer or someone who's looking to buy their first investment property who you're trying to help out. So, number one, they've
yeah,
increased the taxes on shares, ETFs, investing in the stock market, for
yeah,
example. So I can, name you so many people that I know that are below 30 years old, under 30 years old, and they're actively investing in the stock market to
even
turn
our mutual
10,
clients.
even mutual clients, exactly, like just to turn 10, 20 grand into maybe a house deposit. So now that investment, while it's still a sound investment, because of the tax changes, you're losing half your money now. So it's very
Yep,
hard for you to even get ahead. And we all know your salary is not increasing, especially in that age bracket at the moment. It's
yep,
not increasing, maybe even with the same rate as inflation today. So
yep,
they're actually doing a lot worse. And to your point, so actually, just back on that, that's really good example of why I think it's a government cash grab because there's no reason to do this, especially if
yep,
you're talking about let's get first-time buyers into the market, let's improve housing affordability. That's not doing any justice to them. The second thing here is with negative gearing, it's crazy how they've grandfathered it and then they're trying to say again that's going to help housing affordability. Because to your point, all these investors who they're trying to target, there's no loss to them because every property they own, nothing's changing from a negative gearing perspective. And only when
exactly.
people are trying to get in the market, then they lose out on those benefits. Now, obviously, people will say, but they should never have these benefits in the first place. But let me put it out this way. Your average investor buys one or two properties. Those negative gearing benefits don't really do too much for you. It's not a massive deal, like, game changer. It's not something that you're going to really benefit of too much. To your point, buying the property in the right location, unaffordable locations are going to hit the most with negative gearing because now when people can't claim negative gearing in a property where the holding costs are 40, 50 grand a year, then that's a massive loss. So those locations will take a hit. But for your first-time buyer, there's no impact of negative gearing that they're considering, number
Yep,
one. Number
I
two,
agree.
a lot of first-time buyers aren't going into the market under an owner-occupied loan because your borrowing power significantly reduces for your own home because of so what's going to really happen is in this scenario is they're going to lose about 20% of their borrowing capacity. That's key here. So when they're losing about 20% of their borrowing capacity, they're already looking at a more affordable range in the market. And the entry point might have reduced from an 800 grand property maybe to five, $600,000 property. But all of
100,000.
a
Yep,
sudden you're priced out of the market again. So
yep,
into general fairness, all this housing affordability talk that they're, hyping up the budget previously, after the budget, I think people are now seeing through this, which is really good. And they're seeing that, to your point, the government made a lot of promises. Firstly, they can't keep them. And now every kind of policy change or anything that has changed in the budget is impacting, to be honest, the younger Australians the most. And that's the vote to try and even get in the first place. So it's a bit crazy, man. But I think let's break it down. So like, there's a lot of changes, obviously from a structural perspective, accounting,
yep,
how it impacts wealth. So let's start with negative gearing as a whole. So we kind of touched on negative gearing here, but
yep.
from your perspective, how are you educating your clients, people who are building wealth for property, how are you educating them moving forward? What's the key changes here? Because in my assumption, we never, go into property investment for negative gearing.
Right.
It's just
Yep.
it's a function of investing, yes, but that's never the
Exactly.
goal. So if
Yep.
you're getting growth on property, but like you're losing out on $3,000, $4,000 a year of negative gearing, tax
Yep.
benefits, not a game changer for us. So it's never impacting us, never changing our strategies. But how's it been for you and what are you seeing in the market right now?
I think Raghav, the main point, as you clearly mentioned, like if you're going into the property market just purely because of negative gearing, in itself, it doesn't make sense. Like
Yep.
for losing a dollar and getting 30 to 47 cents back, that itself is not a very good strategy. You're going there to get capital gains, and over the years, you accumulate the gains and sell the property for a good gain and get the 50% discount. That was the main gain. Now what's happening is negative gearing was just a functional benefit. You used to get some of that back, which personally was only about 4 to 5 thousand for majority of the people. And what that used to do majorly was that it used to help with the borrowing power.
Yep.
I think that's the real key that is going to get affected.
Yeah.
It's not the actual cash flow that is, such a big problem. Because what's essentially happening is, just for people who doesn't understand the changes, negative gearing is not abolished. What's happening
Mhm.
is it's just going to keep going forward until the point where the property either becomes positively geared, or you make a real capital gain.
Yes.
Right. And you'll be able to offset the negatively geared losses, accumulated losses over the years against the capital gain or the positively geared property. And we all know after 3 to 5 years, majority, if not all the property become positively cash flowed. Right. So to the point, negative gearing is not a massive deal anyway. So you still, first of all, it's still grandfathered to the established homes that were bought pre 12th of May 2026. For
Yeah.
people who don't know, if you sign the contract pre 12th of May 2026, you're not impacted at all. If it's a new investment or established home, you'll still be able to negatively gear the property. So it's like a golden goose. You'll hold the property for as long as you want, and you'll still be able to negatively gear the property and get the benefit. And essentially, when it's time to sell, you can sell the property, still get the capital gain discount until 30th of June 27, and you can dispose the property off. But to the point, negative gearing, I think the main effect that that's going to have is on the borrowing power. I was
Yes.
talking to one of my mortgage broker friend, and he mentioned that these changes, if it gets legislated, first of all, the borrowing power for a first-home buyer is going to get demolished.
Yep.
Firstly, if they go into a property that is already an established home, they won't be able to negatively gear that, which basically means that 20 or 30% of the borrowing power is gone. And for majority of people, that means that from $1 million worth of borrowing power, it's gone down to maybe 800 to $700,000, and they might not be able to find a reasonable property for that sort of range in metro cities. As we all know, the house prices have gone up in the last 5 to 10 years, and from what I'm seeing, they're still going to continue going up. So until there's a real downfall in the house prices, which I don't really see that happening, especially given the immigration numbers. I don't see the house prices going down, but the changes to the negative gearing and the borrowing power, that's going to make the bigger impact on the house, or rather the ability of the first home buyer to buy the actual property.
Yep.
So my recommendation, obviously we can't give financial advice to anyone, but to the clients that are coming to us, what we're telling them is just don't panic, stay focused on the fundamentals, demand and supply. If there's enough demand in the market, the prices will keep going up. It doesn't matter if you can't negatively gear the property. In 3 to 5 years, once the interest rate starts to fall down, once the inflation starts to cool down, we'll see the cash rate go down, and then we'll see less and less amount of interest being paid towards the bank, and we'll see with the rental market going up. Um, Especially given the negative gearing changes, we'll see the rental market going up. You'll get to a stage where after 3 to 5 years, the property becomes positively geared. Then you'll be able to offset those losses against the positive gearing, or if you decide to sell the property off, you'll be able to offset it against that.
Yep.
So that's
100%.
that's my
Yeah.
basic recommendation to a lot of these people. Again, you have to be very careful with these investments. A lot of the a lot of people, just purely because you'll get 50% discount on negative gearing, shouldn't go for a newly built home. In the right location, it still makes sense. But if you're just buying an off-the-plan apartment just purely because of negative gearing and 50% discount, that in itself is not the best strategy.
Correct. 100%, man. And like, if you're looking to build a portfolio and invest, you should understand the numbers behind that. That's what we do with every client. So if you understand the financials, the numbers, the holding costs, we're not even accounting for negative gearing benefits in this modeling,
Yep.
in that modeling.
Yep.
So that will show you all our clients that, hey, in the next 2 to 5 years to 10 years, this is the wealth you can build, not including any of these, tax benefits, which are great. But ultimately,
Yep.
the goal is to hold the property. So for a lot of clients, when you're looking at the numbers, the properties aren't too negatively geared regardless, which means the holding costs aren't too high. So again, you're more on affordable pockets. They also decline. Last time they removed negative gearing around 1985, the market as a whole declined 2 to 3%. Obviously, driven by the more unaffordable pockets. But at the same time, rents in any city where vacancy rates were around 1%, they increased 30 to 40%. And the
Yep.
government modeling has said negative gearing will only increase rent by $2 a week,
That
which is
is
insane.
crazy. 30
It's
to
insane.
40%.
Yeah, so every city across the country today, or at least the top suburbs at least, have vacancy rates 1% or lower. So I am expecting rents to surge. And to your point, the main issue is it's drastically reduced borrowing capacity, which is again working against your first-time buyers, against people who are coming into the market already, which is not doing what the government is supposed to do, which is make housing more affordable. That's all supply demand related on top of that.
Correct.
Yeah, I
Correct.
think negative gearing again, like my view would be to keep it, or like if you're going to grandfather it, these guys are now missing out. Everyone trying to get into the market, so it just doesn't make any sense.
Yep.
Ultimately, you're
Yep.
hurting the first time buyer a lot more than any investor, in my opinion. But yeah, I
Yep.
think negative gearing we covered. So next thing, right, was just more around CGT changes. So kind of mentioned about increasing tax across the board. So give me your thoughts there, and what are you seeing from a solution point of view, or something that we can help clients if you're looking to build long-term wealth, help structure things in the right way.
Okay, just before we get into the opinions,
Yeah,
the changes are very briefly, any property that you've bought now or earlier, you'll still get the 50% discount till 30th of June 2027.
yeah,
Only after 1st of July 2027, the new cost-based indexation method will come into effect,
yeah,
which basically means that if you've already made a gain of, let's say, 200 to $500,000, you'll still get the 50% discount. So majority of the gain is still covered. It's only for the gain made after 1st of July 2027 that will be subject to that indexation, which basically is not as bad as it sounds. It's not the same for people who are just buying the property and flipping the properties, but it's definitely not going to have a huge impact on those people who are, holding the property for 5, 10, 15 years. Rather, it might even work better than the 50% discount. So from a structuring point of view, I think we'll still have to wait and see on a lot of these changes and whether those changes get implemented. I don't want to rush into anything, but from what I'm seeing is with the trust changes, with the bucket company changes, I mean, I think we're moving forward towards maybe a new structure, which is just a PTY limited company structure,
mhm,
where your maximum tax rate is capped at 30%,
yeah,
and as long as you quarantine the funds within that structure, and it also, what that does is it allows you to preserve the borrowing power. And also on top of that, you also get the land tax free thresholds,
yes,
which is a key thing. Like in your personal name, if you keep accumulating properties, you'll get to a stage where either you'll burn out your borrowing power, or you'll get to a stage where you'll end up paying so much land tax, especially in New South Wales, where the land tax can be significant, given the property prices. So you have to make sure you use all these structures, but we'll just have to wait and see. But when it comes to structuring, we'll first have to wait and see whether these changes get implemented.
yes,
But from what I'm hearing, majority of these changes should.
yeah,
But if we go into the next election, which is going to be in 2028, and if Liberals come back into the power, we'll see majority, if not all, the changes being repealed.
yeah,
So, and all of these changes start from 1st of July 27 and 1st of July 28 anyway. So we might not even have any effect. So personally, I'm telling my clients to just stay calm, focus on the fundamentals,
mhm,
don't take any panic decisions. If you can afford to hold the property because you're still getting the negative gearing changes anyway. And all of the gain that you've made over the last 10, 20, 50 years, that's still secured in the form that you'll still get the 50% discount until the gain made till 30th of June 27. Right, so there's no need to panic as such. Yes, you have to be proactive. I agree. There's going to be some great windows in the next 6 to 12 months because not everyone's financially educated, as we all know. Some people just got into the market just purely because of negative gearing, and now since that has been removed, they might end up selling the property. So there might be a really good window where you actually find the right asset for you, which might be at a 10 or a 15% discount. That's how I like to look at it. But I would love to hear your thoughts on that.
fully agree with everything you said. And I think to your point, like it's just really important that people understand that these structures don't have to be changed today. And obviously,
Yep,
with an election coming in 2 years, then is it even worth making significant changes to your structuring? I think that's the main thing. So, in this aspect, that's why we rely on people like yourself, experts in this field, who we can
yep,
make sure we're getting the right advice, understand long-term implications. Everyone's
yep.
financial situation is different, so one structure for one individual may not work for someone else. And this is why it's
True,
very important to have the right strategy and talk to the right people. If you have the right
true.
team on board for, all of these changes and what's going to happen with policy changes, the property prices, structuring, taxes, like you'll get confused. If you're not the right team, you'll get very confused and you'll get overwhelmed and you won't make the right decision. So if you're working with a team of experts, you're going to be guided in the right way. So ultimately, at the end of the day, if you're looking to build wealth through property, to your point, fundamentals will be the key priority, and they'll overtake all of these policy changes, negative gearing, anything else. Because if the property value grows, you're doing well. I think that's the main thing.
Exactly.
But just to take it back one step, I just think overall, if you're relying on taxing people more in any country, it's not the way to
Yeah.
go. It's not sustainable. You're not going to create an economy where people want to be here and work and build. So right now, like I'm seeing every day there's AI memes of Albanese as like a shareholder in the company, and he's getting paid
Yeah.
47%. And I think
47%. Yeah.
it's justified because people here are working so hard just to try to get ahead. They're taking all the risk. If you're investing, you're taking a risk. If you're starting a business, you're taking a risk. So this takes time, effort, everything else. And now you're not incentivizing us to grow the economy, grow ourselves. And these are the same people that is driving innovation in an economy that honestly is very slow at the moment, and there's nothing coming out of Australia. There's no growth coming out of Australia. There's no innovation coming out of Australia. We're very focused again on agriculture, our big four banks, and then you've got the retail. But in general, there's no tech innovation. There's nothing coming out here to significantly grow the economy, and that's where the government has to do their job with the natural resources. But as us as innovators and entrepreneurs, we're not being incentivized. Now,
I agree.
I've heard a lot of commentary online about the rich should be taxed more. And to some extent, it may make sense, but just keep this in mind. The more you tax the rich, the more you're also basically pushing them out of the country. And those top 10%, they're creating all the jobs here as well. So there has to be a
Right.
fair balance. I'm not saying they shouldn't be taxed. What I'm saying is it needs to make sense. And right now, it's just not making sense. All the founders that we're talking to, anyone who's starting their own company, they're looking to move on offshore if they've already started one in Australia, or they're not even going to bother building in Australia now. So what are the long-term implications there? So since honestly, since we've been, here on this earth, there's always been kind of your top 10% of people who are building in whatever way, whether it's companies back before, whether it's in the industrial revolution, the internet revolution, they're building. And that will create the next wave of, growth for our economy, the next wave of jobs. All that is being created by them. So if you're not incentivizing them in Australia, you're losing that top
Somewhere
10%.
else. Yeah.
And that's
I
just a
agree.
big risk long term because we have such a great lifestyle here. We have a great country. We're doing everything right, especially with all these geopolitical tensions today. Australia is still very favored. But
Yep.
all of these taxes is flipping the narrative. And I
Correct.
think that's the main risk from my perspective. Again, things should be fair, but like in my opinion, like taxing us more is never the way to go, especially when it's so apparent that you could be a very, very wealthy country today if you again maximize on gases, natural resources, minerals. But we're not doing that. If they weren't existing, if they didn't exist in Australia, I would understand this more, but they exist. And
Right.
we're favoring a lot of private companies and specific lobby groups over the everyday Australian here, which is just it's unexcusable. It's not there's no excuse for that in my opinion. So I think that's my main view on tax, man.
I agree. I think whatever you've said, I can see the pain.
Yeah,
I'm seeing this pain with a lot of these young investors, not just the 10%, by the way,
yeah,
a lot of these young investors as well, because you're the one actually taking all the risk,
correct. Yeah,
right? And if you somehow succeed in the property or the share market or the crypto market, whatever market you choose to go to, and you'll end up you have to pay 50% of that to the government, that really, really doesn't make sense. Like that's just basically incentivizing the investors to go out there, um, apply innovation and get to a level where you're actually building wealth. Because a lot of these founders, they're not taking a lot of wages out of the company anyway. They're relying on the capital growth from the shares. Like
yes,
if it's somehow the top one or the top 5% succeed, that doesn't mean they should be taxing 50% of the gains that they're making.
yeah,
They're the ones taking all the risk. They've put they're working on the weekends, they're working long hours, they're working 15 hours a day to get to a level they're actually building wealth. And it's just
100%.
not helping the company itself, it's helping the overall economy. Like they're
Yes.
not just building jobs, it's helping other people to, invest in certain locations as well. Like, for example, if a owner does well and he offloads some of the shares to the employees in the form of ESS,
Yeah.
I mean, those, if the ESS shares are going up, that allows other people to grow as well. It's just not the founder itself that's growing. And if you're going to tax not just the founder, but also the employees who are getting these ESS share schemes, that's just disincentivizing them from just getting those shares. They're just better off getting the wages. And we all know that the
Exactly.
wages growth hasn't been at par with inflation, or the real wages haven't grown in the last 10, 20 years. So that's not helping anyone. So now what we're seeing is just the cost of living pressure is just so high that people are relying on these investment activities just to get through. If they're helping themselves, towards retirement and not relying on the government for pension, I don't know how that is wrong.
Yep.
It doesn't
Agree.
make sense. And I just want to add that, look, we spoke about broken promises. Now, what's the guarantee that the government's going to say something in the election agenda and not backflipping from that
Yeah.
agenda without proper debate? Like, what happens if all of a sudden everyone's going into super funds now, or self-managed super funds, because the tax rate on, if you do it on outside, is so high that people are going towards super fund and building wealth in the super funds. Now, what happens next? Because obviously the government's losing money now in the
Yes.
super funds. What happens next? Does the tax rate increase from 15% to 25% for your pension fund? Like, where does it stop? Like, that's my question.
100%, man.
So we just have to wait it out and see how these changes are taken by people. It's still
Yeah.
very early days.
Yeah.
People are panicking. A lot of people are upset. So, very small majority of the people call themselves winners in this budget. To be very honest, this is the first budget I've seen in a very long time where there's less than 10% of the people who are actually happy with the changes.
Yeah.
More than 90% just feel that, for whatever risk they're taking, they're just going to get taxed at 50%, which is not really good for the economy. Like, you'll see all these changes in other countries like New Zealand or Singapore, but they're not even taxing the capital gains at
Exactly.
all.
Exactly.
The capital
Yes.
gains in Singapore is 0%.
Yep.
Capital gains tax in Singapore is 0%.
Yep.
And we all know what happened with negative gearing in New Zealand. Like, the rents went up, to your point, by more than 10, 15, 20%, with a very slight decrease in the house prices.
Mhm.
Uh, which, I mean, again, it's not a huge deal. If you've made a gain of 50% over the last 5 years, even if it goes down by 10%, it's not hurting anyone.
Yes.
So to your point, I just want to see what this government is doing and how far they can go with the changes. We'll
Yep.
still have to wait it out and see if these changes get implemented or reversed by the new government. We'll just have to wait it out and see. But to my clients, I'm just telling them not to panic.
Yeah.
Keep Stay focused on the fundamentals, demand, supply. If it makes sense, if you can afford to keep it, keep it. If it
Yep.
doesn't make sense, if the supply is increasing, then sure, offload the property and realize the gain. As simple
Correct.
as that.
Correct. Yeah. Yeah. And we're not politicians. We're not, too into politics, to be honest. Like, we don't want to go on about like policies and everything else. But like,
Yeah, I don't want to politicize it.
when it's so
Yep.
clear that, certain things have been implemented which are just disadvantaging everyone and not helping majority of Australians, like there has to be some kind of, like protest or voice to be heard, because like this can't continue. And to your point, the government can't lose trust. That's one of the most important things that you're building. So that's why we have, this voting system, and people go out and vote based on what you're telling us. So, but overall, man, like I think apart from, the root cause, which I think is we're not, generating revenue as a country, and that, basically lies again, natural resources, minerals. Like I would have loved to see a few things come in the budget apart from that. Number one, like if you look at stamp duty, that's probably like, you know, I reckon the key reason why a lot of people can't enter the market, because that stamp duty costs us 30 to maybe even 100 grand depending on your property price. So that's an upfront cost that people have to pay in cash. And
Correct.
we've taxed Australians enough. There should be more kind of incentive to reduce stamp duty or remove stamp duty from certain transactions. I think they didn't touch on that, number one. I also think that like in general, if you want to improve this overall housing crisis, you have to tie migration levels to new supply. There has to be some kind of policy there for sure. Because right
Yeah.
now, our economy will continue to weaken, in my opinion, especially after this budget. And you will see that we're not building enough homes, but we're still taking in a lot of people. So if there's no correlation there, this housing crisis will get even worse, and we're nowhere close to fixing this, by the way. And like ultimately, I just think in general, like we've discussed in overall, like housing supply here itself. There's so many bottlenecks here. There's so many issues with council approvals. Again, there was no discussion how to improve these things. There's key
Yeah.
fundamental issues. And I think, again, a lot of it stems from generating revenue. And even now, we know the government's spending like crazy. They're not focusing on, building more revenue. We've got memes online about our finance treasurer, losing $30 billion and not understanding the difference between net and gross profit. But at the same time,
Yep.
everyday Australians are suffering. And now we're
Yep.
suffering even more after the budget. So that's where I think the frustrations lie. And I'm hoping we see some change. Again, when we're not debating the politics of this, this is just pure policy
Yeah, I
that I
agree.
think will help everyone. And yeah, keen to
Yep.
hear everyone's thoughts, whoever's listening to this. But yeah, well, any suggestions from yourself? Like, how do you think that we can also improve the situation?
I think, as I said earlier, that's what we're sticking to all of our clients as well. You
Yeah,
should speak to the right team, first of all. Get proper financial advice. It's more important than ever to get proper financial advice now,
yeah,
than ever. Like, have the right team in place so who can help you with the structuring. Because imagine a situation where you keep buying the properties in your personal name, demolish your borrowing power, and get to a stage where you can't even afford to buy, your primary place of residence. You don't want to be in that sort of situation. So it's more important than ever to have the right team in place, focus on the fundamentals, buy in the right locations. I would still 100% recommend that, don't get upset about the changes too much. Still stay focused on the fundamentals. Connect with the team that aligns with your strategy, whether it is to build long-term wealth or just to get your first home or foot into the market. Whatever that strategy is, get in touch with the right team, and just stay away from the noise pretty much.
yeah,
Like, the more you hear about all these headlines and all these changes, the more upset you're going to be, and the more disincentivized you'll feel about these changes. So in general, like, it's not all doom and gloom, as I said. Whatever you, if you've already bought the property, you're still grandfathered anyway. And after two to 3 years, if those property that were grandfathered becomes positively geared, now even if you go ahead and buy a negatively geared property, that's not as bad because you can offset the negative gearing changes against the positive gearing,
correct.
right? So it's just the first home buyer who's gonna suffer. It's not
Exactly.
the people who've already built wealth.
Yeah,
It's gonna be the first home buyer who's gonna suffer. And to your point, if the supply is not increasing, if there's not going to be more stock in the market, and if people are going to hold the property, I think personally, I think the state government is also going to lose a lot on the stamp duty to revenue as well.
yes.
So that's going to have a lot more flow on effects in the economy. So they might have to revert back to the changes
Yeah.
pre budget anyway. So we'll just have to wait and see how these changes pan out.
Exactly, man. And then you mentioned something very important. Now, this is just purely from an investing point of view. If you're looking at all of these, policy changes, geopolitical tensions, like you're going to get again overwhelmed. You'll get scared.
Correct.
You'll make panic moves, and I think that's something that's going to be very detrimental to any investor and their psychology and their ability to move forward and scale. So if you just take a step back, and these are facts, like
Yep.
if you look over the last 40 years, so in the modern economy, the Australian property market has only declined 8%.
Yep.
And that's the longest that 8% decline went for was over, I think, 19 months. So in the grand scheme of things, at 8%, by the way, wasn't every suburb's declining. It's
Correct.
8%
Yeah.
median price across the entire market. Again, likely driven by more unaffordable locations. So
Yep.
if you can bear an 8 to 10% loss, and I think in some locations property prices will decrease 10, 20%. They have
Yep.
again in 2022. Again, these are unaffordable locations where the fundamentals aren't there today for growth. But again, if you're doing your research, if you understand the data, if you understand the best locations that have the best chance to grow, not only will you avoid a negative drawdown, but you'll likely get growth in declining market and you can get
Yep.
further ahead. So if you just remove all the noise and you just focus purely on fundamentals, the Australian property market is a backbone of the economy. It's a human requirement, it's a necessity, it's a hard asset in an inflation time period,
Yep.
and we've got no supply here. So this is, and I still agree that again, there's a lot of people that think property shouldn't be used as an investment vehicle. But to be extremely honest, the entire world economy is based on debt. It's based on inflation. The value of the dollar is going to keep declining. So the system is not changing. So whether you like it or not, hard assets, including property, will keep on going up in price. They're going to keep increasing and keep growing. So that's not changing. So it's best to, I think, play the game and make sure we're securing both. And you're doing a sustainable manner. You understand the numbers behind it. Take advice from expert teams, so you make sure that you're making the best decisions. I think that's the key here from my perspective as well.
I agree, 100%. I think you've summed it up pretty well.
No, amazing, man. Like, and I really appreciate you having you on today. And I know that, we'll talk about the budget more and these changes once we again align on how to structure things. Maybe we'll do one more part on, just purely investor
Yep,
focused
yep,
structuring and, going into deep dive there when you have more thoughts and more clarity.
100%.
Yeah.
Right. Thank you for having me again. I think we'll have a detailed chat about the structures and what
Yeah.
structure works best in this economy. And after all these changes have been improved, we'll have a podcast again to go through the changes, to talk about the pros and the cons, like we did for
Yes.
self-managed super fund, for the trust, for whatever structure you might have thought is going to help you get forward.
Yeah.
We'll talk about that structure in the future videos.
Sounds good, man. I appreciate it, man. Have a good day. We'll speak soon.
Thank you, Raghav. Thanks,
Yeah.
man. You too. Take care. Bye.